Hey guys, Taylor with GammaEdge here coming at you with a post-market recap for April 1st, 2025. Our key transition zones did a great job of encapsulating price action today, and let's show you how we got these as part of our pre-market routine. First off, if you want a pre-market routine each morning, we give away most of it for free. You can get that at GammaEdge.us. Pre-market routine has three phases though. The first is we want to understand trend and momentum in the market. We do that through our market trend model. Next, we look at options market positioning through the lens of SPX. And then we look at the 0DT complex. So this is the market trend model. The backbone of this is built off of the tick index, which that just simply measures buying and selling in the market on a real-time basis. You can go to Investopedia to learn more about the tick index itself. But what we do is we take the raw unfiltered tick on a day-over-day basis. We create a time series out of it because it resets each day, so we can understand short-term and longer-term trends. That manifests through this bolded white line, which we call our cumulative tick. And again, last week, this was trending lower. Below our short-term moving average ribbons, it has what we call a railroad track down signature. So from a swing trading point of view, when we see the cumulative tick trending lower below the railroad tracks, that is generally a bearish sign where we expect sideways to down price action. And then we have something else that we overlay called the filter tick, which is this bolded cyan line. And this is when we have readings from the tick index itself of plus or minus 1,000, because those are generally accepted benchmarks by the market as being large significant transactions. So last week we saw significant selling for most of the week right there. Then yesterday, you should notice that there was a bit of a character change in the immediate term. That being the cumulative tick trended higher on the day, crossed above its railroad track. So that is somewhat of a bullish signal. Or I should say why it's not screaming bullish. It's at least saying, hey, for the time being, we've stopped going down. Momentum on the shortest time frame has shifted. So what we were saying in the video yesterday is it's key that we see follow through today in this. And then just hitting yesterday, we saw a little bit of filter tick buying in the afternoon. But just note the magnitude of this buying versus this selling. This is a lot bigger than the buying we saw. Again, understanding after understanding the general trend and momentum of price itself, as I previously stated, we then go and we look at the options market complex for the SPX. Why the SPX? Because it's the largest, most liquid options market there is. And it's a very good gauge to understand general sentiment and trend because, the options market is forward-looking by nature. Something unique about the SPX that we do at GammaEdge is there's two components to the SPX. If you didn't know, there's the SPX-A, SPX-P. SPX-A you can think as the cruise ship. This is where your monthly and your quarterly expirations are contained. This is longer term, more strategic money that places their bets here. And then there's also the SPX-P, which is your 0DTE, your daily, and your weekly expiration. So that's shorter term in nature. Think of that more as your cigarette boat, because again, there's more short-term speculation happening there. So first off, starting with the SPX-A, to get kind of a broad understanding of the landscape, this is all expirations. And here we can see, if you guys have been watching these videos for a couple weeks now, all we see is red. So again, continues to be a put-dominated environment. Really not a ton else to say there. The other tools that we had that we look at in the pre-market, those are really not suggesting that there is any meaningful call speculation coming in on a day-over-day basis. Just as a reminder, what a call dominated structure looks like, here's a past example. So you can see, the biggest thing you should see is just green everywhere. Call dominated strikes up and down the structure. Again, this is what a constructive kind of bullish foundation looks like. Going back up to SPX-A one more time, this was certainly not the case heading into the market open today. After going through SPX-A, we then go to SPX-P. Again, all expirations are turned on. This is your cigarette boat. Shorter term speculation here. Again, this is a put dominated structure. I know that our purple transition zone gets in the way a little bit, but these are all red strikes right there. Have a little bit of call dominated strikes below, but we are seeing no out of the money call speculation. So again, a lot of work to be done there. And then you can see the transition zone here is very wide, very loose. This is indicative of markets undergoing a transition or have a lot of kind of implied volatility baked into them or put dominated too. And that is the case here. Again, this is our DEX transition, the purple box based off of delta and the distribution of calls and puts. So at a minimum, the bottom of the DEX transition zone is 5,600. So if you're a bear, you want to see this level defended. If you're a bull, you want to see this level overtaken, but just because it's overtaken doesn't mean that, everything is well. We want to see this overtaken. We want to see calls start to come back in above spot price. We want to see the market trend model continue higher. And then keep in mind the SPXP generally shifts before the SPXA. So obviously this isn't the case right now, but in the coming days, in the coming weeks, we're going to be looking to see when that call speculation comes back in, and this should ultimately manifest into the SPXA. So the progression of our turnaround framework goes first, the market trend model turns, then SPXP starts to thaw out, and then SPXA starts to thaw out. And again, really nothing like that is happening so far. The market trend model is turning ever so slightly. So after going through SPXP, we then shift our focus to SPX0DT because that's kind of its own beast a little bit, although it's important to understand the context of the market overall is kind of put dominated. And so from a swing trader's point of view, your market trend model moderately higher yesterday, but still in an overall context of a downtrend. SPXA, SPXB are put dominated. So favorable for a swing trading environment to the long side? No, it's not. So now looking at SPXP0 DTE, we have puts in control above spot price, calls in control below spot price. This is a normal structure to see in the 0DT specifically. And so what we do first is we understand our transition zones. Again, our DEX and our GEX transitions, which are based off of delta and gamma respectively. Those were showing confluence at 55.85 was the bottom, 56.05 was the top. So just as a quick refresher, in between that transition zone, this is where dealer market maker hedging requirements are at a minimum. So price is free to meander without any kind of other influences. So we expect choppy price action is generally how price action is characterized within this zone. Above this zone, this is where calls start to have more influence on price itself. So we expect to see a move higher here. And below the transition zone, this is where we expect to see expanded volatility. This is where puts become more dominant in the structure, and we expect to see more sideways to downward price action there. In addition to the DEX and the GEX transition zones, we also have a zone called the drunken sailor zone, which is based off the distribution of net open interest and call and put speculation in the complex. And that was defined at 56.25 down through 55.50. And the way that you can think about this zone is while we may break above or below the DEX or GEX transition zone, there is still little call influence above that and little put influence below the DEX transition zone through the top and the bottom of the drunken sailor range. So I say all of that to say that intraday volume in the physical opening and closing of contracts is going to play a much bigger role than the moneyness of the options, shifting from out of the money to in the money, and the associated dealer market maker flows that come with that. So that is where our intraday volume analysis is key that we will get to next. But just to recap this, the reason that we do the process the way that we do and the way that we develop those transition zones is because we have very good go, no go zones on an intraday basis. So in between the GEX transition, DEX transition zones, and really the drunken sailor zones, this is where you should experience choppy price action. So the expectation, some kind of trending move should be at a minimum, and if you are dying to trade within the zone, it should be more of a quick scalping environment as opposed to once we break free of these zones, that's where our trending moves really start to manifest with the confirmation of intraday volume analysis. So going to the chart itself, here's a 5-minute chart of SPX. I have the drunken sailor range drawn in the teal box. I have the DEX and the GEX transition zone drawn in the purple box. And just stepping back, most of the price action today can be contextualized within the drunken sailor range. And effectively, we just meandered back and forth throughout the session. And you can see when we do have those meandering sessions that there are strategic points where you could potentially have trade setups, from the top of the drunken sailor zone as an example, back to the DEX transition zone as an example there. And all of that leads us to this chart. This is an encapsulation of our intraday volume analysis. We call this the vol-M chart for volume momentum. Clever, I know. And so what this chart effectively does, or what we are doing here, is on a 5-minute over 5-minute basis, what we do is we aggregate all the call and the put volume. We understand the distribution of that. We find the middle point and we plot that dot. And that middle point of the distribution is what we call a centroid, center of the mass. So we plot that on a 5-minute over 5-minute basis. We connect the dots for you. So at any point in time, whenever we're looking at this, because again, this chart reproduces on a 5-minute basis throughout the session, we can understand what the behavior of the call and the put speculators have been. And then we can infer based off of what the behavior has been, all things equal, what the behavior of them is going to be throughout the duration of the session. Backing up real quick, one thing I forgot to share that we shared as part of our pre-market game plan to the community is this is a command called netstat. What netstat does is it is a quick summarization of the 4 key Greek influences, those being delta, charm, gamma, vana, delta being the first order, charm, gamma, vana being the second order, meaning that they impact delta. But delta is the ultimate form of risk, right? And so what this essentially does is this tells us who is dominating above and below spot price. So again, here we could see that in the money calls were dominating below spot price, in the money puts were dominating above spot price, and then the magnitude of the in the money puts was a lot, almost 3 times as big as the in the money calls. But also what was important are these key strikes. And so effectively what this table is telling us is that 55.50 is a key strike to the downside. Again, right, this strike is net in the money call dominated. So if we were to flip this strike, then that turns those in the money calls to out of the money calls and those out of the money puts to in the money puts. And so that has a big shift on moneyness. And what was introducing positive flows in the market is now introducing negative flows into the market. So this 55.50 was a key level that we were looking at to the downside. I just don't have it marked up on the chart because I cleaned the chart up a little bit for this presentation. But we can see when we got that downside push, it stopped dang near right at 5,600, which is a key psychological level. And then that 55.50, I just say that because that was the bottom of our drunken sailor range as well. So we were seeing confluence there too. But nonetheless, that initial push lower, it started and it stopped at the top of our DEX transition zone. Then we were never able to break below the bottom of our drunken sailor range. And then the whole reason I went through that is because what I was getting at is once we saw that push was not able to break through that 55 or through that 55.50 level. Sorry, I realized I just messed that up. This was almost at 55.50. I don't know why I was thinking it was 5,600, but yeah, wasn't able to make it through the 55.50 key strike that we were talking about. And then we started to see those centroids trend higher. And so what that tells us is that, okay, call speculation is starting to come into the market, or at a minimum, there is no put speculation that is continuing to move lower. And if we just go back and we look at yesterday as an example, when we got that trending move higher, that's what we saw all day was a trending move higher of call speculation. Granted, it wasn't aggressive, but it was still easing higher. And same with the put side was easing higher. We were seeing no kind of material speculation to the downside. So again, we saw that push higher, and that was also confirmed at the same time with our market trend model. Here's what that looked like. So we were seeing, kind of in the morning, a push higher with the market trend model. We were seeing some filtered tick buying as well. And so you might have seen us post on Twitter that, hey, as of right now, the market trend model and our volume were both constructive to the upside. However, this is where it's critical that you're monitoring this throughout the session. The reason being is because what we then noticed was there, after kind of 11:30, there was no continued speculation up and out. If anything, it was actually trending lower from that point forward. So that kind of told us, okay, why are people not continuing to speculate higher? That this is a typical signature that we see when there's kind of a cap on the market. Granted, at the same time, we knew that there was not going to be, a massive downside move, at least at any important time today. The reason being is because we are not seeing that material downward speculation of the put centroid that was still more or less easing higher on the session. And so again, once we get this kind of character of, call speculation trending sideways to lower, put speculation trending higher, this is really where range-bound market conditions start to proliferate throughout the rest of the session. And, if you're a credit seller, this is kind of a perfect signature you want to see on, selling your credit spreads. And then especially within the context of our drunken sailor range, once you start to see price action bound between this, these also offer you really good reference points as well for doing those type of trades. And just so you can see this intraday basis and kind of how you can see the actionability of it, here we are at 130. We can see that the call side continues to trend lower Put side continuing to trend higher, although it's starting to flatten out here as well. And remember, price doesn't go where there are no transactions. So, so long as we have this character higher, then really not expecting a material ramp higher, and same thing to the downside. As long as we're not getting, material speculation lower, really not expecting that anyways to happen there too. So again, this gives us comfort here that, the expectation is range bound conditions until we see something, potentially in the future change, whether that be, a massive spike higher, a continued move lower, one of those outcomes. And just to beat a dead horse here, really we just saw drifting within the transition zone and then back to the top of the drunken sailor range today. That was it. And oftentimes, just for you guys out there, a trade I like to look for too is I use the opening print just as a reference point throughout the day. That's not a GammaEdge thing. That's just a me thing that I do after user trading and just looking at this day over day. And there are sometimes powerful setups where we get, a consolidation around the opening print within the context of one of our key levels. And so today, that was a potentially really good setup because the risk to reward was very well defined. At the bottom of the deck zone, which price was clearly respecting, and then natural targets, right? Up to the top of PlusX or even the top of drunken sailor range, which was well within inside the range of price action today. So with that, hopefully you kind of understand price action better. You understand our methodology of pre-market on how we get prepared to the market, how we understand the longer term and the short term sentiment in the market, and then how we develop our key transition zones. We monitor those intraday in the context of intraday volume as well. So with that, all I got for you guys tonight. Y'all have a great night. We'll see you tomorrow. Thanks. Bye.